All right, ladies and gentlemen, welcome to this video. Today is the 25th of November 2020. It's time to talk a bit about automated trading again, I think. I would like to prove to you in this video that, yeah, it's possible. You can create strategies which are solid, yeah, and where each trade is secured with a stop loss as well. Now, don't get me wrong, it's extremely difficult to design such strategies which will be consistent over several years over different market conditions. To create this kind of robot took me around something like 3 years. Obviously, it's not for sale. I use it myself in different contexts. And I encourage you to create your own strategy. That's very important. Somehow it doesn't work to take other people's strategies trying to benefit from that. You have to actually create your own strategy and understand every single detail of it. So what I would like to do is I would like to do a tick data back test over the last 5 years. So a nice half a decade. And let's use tick data and realistic conditions in order to do that. And let's actually take some retail price data, so to make it even more for the bots to perform. Variable spreads is enabled. Simulate live execution, stop orders, take profit, limit orders, yeah. Margin. Let's put that. Okay, so that helps us to see how the strategy would have performed over the last half a decade. Obviously, this will take a few hours. So what I will do is I will record this and then, time lapse the video. And there we go, it's loading. Okay, strategy is running. Here the performance curve. This is a strategy which is not a high frequency strategy. It does maybe around 10 trades per month, sometimes more, sometimes less. And each trade is secured with a stop loss. Not an emergency stop, but not a super tight stop neither. Depends on the average range, for example. And you can see in some months it does a lot of trades, in other months not so much, but it's quite stable. So it will have very manageable drawdowns. Okay, so let this one run and I'll talk to you later. Okay, ladies and gentlemen, welcome back. After 44 hours of testing, we see our result here on the automated strategy. And let's take a closer look. So, profitable trades 76.71%. That's a win-loss ratio. That's pretty good. When you look at the average loser compared to the average winner, you see that the loser is roughly double the size of the winner. But when you look at the largest winner compared to the largest loser, we have a nice relationship there. But the most important thing is risk versus return for those strategies. So return versus drawdown. And when you look at the total net profit, 113.671k compared to only 25k drawdown, this is fantastic. Okay, so the drawdown is around 4 times lower than the return. And that's what you want in a solid strategy. You want a good relationship between return compared to the maximum drawdown. As I said, it's not a high frequency strategy, 219 trades. So, that's not a lot of trades. But, you want to have something solid as an automated strategy. Of course, there are other approaches which give you more trades or less trades. But typically, the more trades you have, the more risks are involved. It's important to understand, every trade is protected with a stop. There is no martingale or a grid or hedging or whatever, nothing complex, which tries to force a smooth curve. And you can see that at times the EA has a great run, you see, and does a lot of profit. For some periods it goes flat or is in a small drawdown like here, yeah. And when you see 83 to around 117, so easily over 30-40 trades, the strategy can go flat or be down a bit as well, and eventually the next nice run comes. And the length of runs can change. You see we had a nice run here, but also understand that the distribution of trades is not normally distributed. That means in some months the strategy does a lot of trades, in like 10. In other months it doesn't trade so much, like sometimes even only 3 trades per month, yeah. And so that's important to understand. But whenever you have a strategy which can give you some performance like that, that's very good. Yeah, you're on a very good way. Now, there's a good chance that a strategy like that performs for a good few years. Does it still work in 10 years? Well, you can't guarantee that, because things can change on a fundamental level, on a structural level. The FX market is no exception. So yeah, this is this is a pretty good approach. Please remember, this strategy is not for sale. I created it over more than 3 years. I use it for some institutional things I'm involved in. This is very solid. There is no high risk involved. And if in the future at some point the strategy dies, it's not that the whole account blows or something, or there's a massive drawdown. Typically, for example, let's say there's a drawdown in the future, and then rather than the next run it does another drawdown down. You will have time to react and to decide whether you want to switch off the strategy or decrease the leverage, or whether it's maybe not valid anymore. But since over the tested time period under those realistic conditions, we had all kinds of markets, yeah, like trending, ranging, flat, etc. You have a good chance that a very sophisticated strategy like this one here will bring you fun for a few years minimum or even longer. Now you will ask yourself, okay, how did I manage to get this done? Well, the different components, and obviously I don't disclose that, but just to give you several hints, yeah, if you are working on automated approaches. Filtering is key, obviously, yeah, so which kind of filters you use. I suggest you find some efficient filter that allows the strategy to distinguish between a ranging market, a random market and a non-random market, you see, so that's a very important aspect. So the strategy needs to have like some input where it says, okay, there are exploitable patterns and now there are no exploitable patterns and there's a lot of randomness. That is an important component. Now there's a lot of other things like obviously the stop loss should be dynamic. it should be able to change according to range, etc. So therefore also the lots need to be variable, so the EA can decide when to put more into a trade and when less. Break-even rules, trading rules, they're also important. Pay attention to that. You need all kinds of filters, like standard filters such as spread filters, so that some news events are not traded. And then, of course, all kinds of other complex filters. Now, obviously, knowing that I'm specialized in the foreign exchange market structure and the causality, as I call it, of course, I incorporated principles from that knowledge. Yeah, and that's why it's so important to study the market causality, no matter what you do, whether you trade manually or whether you trade in automated fashion. You need to understand the dynamics. That will help you to find good rules for a strategy. Yeah, because if you know, for example, there's fake support, fake resistance, if you know that there are stop runs, post stop runs, move, etc., these are things which you can incorporate also in automated strategies, obviously. Yeah, so there's no wasted time or effort or money to subscribe, to have access to, you know, like the charts, to study them on different time frames, you know, to incorporate this knowledge in whatever you're doing in FX. Okay, I can't stress that enough. And, you know, I have designed everything in a way that now it's accessible to you. So I wish, you know, years ago when I started out, I had the ability to subscribe to something like that. Now the dirty work is done, okay? The tools are all there, so, you know, study them, make use of it as long as you can. Okay, nobody knows what happens in the future neither. So I just wanted to show you it is possible to create good solid strategies which are automated. Yes, it is extremely difficult. It will take you a lot of time. You need to be very, very persistent. You need to really go for it, to go the extra mile. You need to test, I don't know, several thousand hours, I would think, to find the right ingredients, so to speak. But yeah, if you're on that kind of journey, do it. I personally do not believe a lot in buying anyone's strategy. Okay, I think you have to design something yourself because you need to understand all the details. Okay, you need to understand it. For some reason, if you just try to buy someone else's strategy and to apply it, it's never a good idea. Okay, do things yourself. Or if you're an investor, look for, you know, professional setups like the one I'm running here, you know, where you can invest and you're completely uninvolved, and, you know, you have a good chance that, you know, something like this is the right investment for you. But then, of course, you need to be able to have the right risk tolerance, because that's another thing I wanted to talk about. So the one input factor which can be changed is, of course, the risk per trade. Yes. So now here you see I used, I think, 2% risk per trade. A bit more, I think. Let's check. Yeah, 3%. I'm sorry. So the question is, how much risk per trade are you able to tolerate? Of course, you can place less or more. Yeah, but obviously, if you put a lot of risk per trade, you know, then the absolute drawdowns increase as well as the potential returns, of course. Now that's something to figure out, okay? Because investors are so different, traders are so different. Some people are happy to make 10% in a year. Other people, you know, they want 50%, but they don't mind to have like a 30% drawdown. You know, everything is you can justify a lot depending on, you know, what your overall portfolio looks like. You know, a high net worth individual, for example, who already has stocks, who already has commodities, already has real estate, already is involved in startups. If he adds an FX project to his overall portfolio, he of course wants more upside, so he has higher risk tolerance. Somebody who may have a few million and puts $500,000 into a project like this may not have the same risk tolerance and may not have the tolerance for high drawdowns. So these are important factors you should always consider. Also for yourself, if you're a trader, you know, have a very clear assessment of that and a clear opinion. What are you happy with, yeah, in terms of risk? Because obviously what you can do as an automated trader, you can evaluate the market, for example, with the causality, of course, and you can say, okay, now I increase the risk per trade to 2.5%, and in other periods, after that a good run, you may say, look, I decrease it down to 1 or 1.5%, or even below, trying to smoothen out the curve a bit more, yeah? And, you know, this is completely valid. You can do that, yeah? So that's a good idea. But either way, you also have to be careful that you don't intervene too much in a fully automated strategy, because what you don't want to do, you don't want to intervene so much that you destroy the nice runs, and you actually increase drawdowns, etc. So it's good to define a range for the risk per trade. Yeah, let's say from 0.5% up to 2.5%, and that's your range. That's only how much you can change the risk per trade. Yeah, as an example. Okay. All right, cut. Okay, so let's also take a quick look at the kind of trades. You see here the lots, which is, and you see like there can be a few losing ones. It's very balanced, I would say. These are the periods which you see reflected here. And also take a close look at those numbers. You need to be comfortable having those kind of winners and losers, yeah? And another thing, by the way, look, if you have a strategy and it's proven, be careful that you do not intervene too much into the strategy, because look, if you only have a handful of trades per month, if one trade comes and you quickly cut it and you take a few pips profit for whatever reason, in the worst case for emotional reasons, you may, for example, cut away a nice winner, all right, and then the month may end up overall in loss. These are factors to really consider. All right, so I encourage you to work on your things. Now, personally, as you know, I'm a manual trader as well as an automated trader. I like both. I do both, yeah, because obviously having a strategy like that running, it will not give you a trade every day. If you do manual trades on the causality side like I do, you will have a few setups per day. For me, that's a perfect combination, to have like automated strategies in the background where they're more statistical, and then you trade the market causality manually every day, every night. That's what I'm doing, and I think that's a good idea in general. Okay, so what I will show you now is based on the strategy, you can create different variations of it by slightly allowing it to, for example, place more trades in the market or less. And rather than showing you the whole backtest, I will just show you the results. So that's one variation. Let me walk you through a few examples. So obviously what happens is you can smoothen out the curve by adding additional filters, reducing the trade frequency more. But one strategy version I like is in particular this one. So you see in this particular version, it does pronounced runs interrupted by little stop outs, and then when it goes flat, it tends to go down a bit. Let's look at the data. So you see an increased win-loss ratio, 79%. The relationship between drawdown and return is still very, very good, around 4.5, 5. I'll also show you this particular variation. It's in a bit of in the middle, so it's also rather smoothened out, pretty stable. So that one would have a win-loss ratio around 74%. Yeah, so basically what you should do is you should take a strategy, you should run it on different data. Yeah, so don't only use one data set from one broker, okay? Download all the data sets from different brokers, different ECNs, run the strategy, okay? Also play with the different factors. Play with the variable spread, with slippage, with commissions. Okay, try to make it as realistic as possible. And then in the next step, you run the strategy on a demo account live. You see whether those backtests are realistic. And if yes, once the demo confirmed it, then you can go on to the live trading. All right, and then make sure that because that's your responsibility if you trade in an automated fashion, you need to make sure that everything is set up, okay? Either you use a VPS or not, but you need to make sure there's a battery in case of a power cut, that internet works, that your machine works, etc. Okay, you need to keep an eye on this, that all the settings are correct, that there are no errors, and then you're good to go. Anyway, so this is a fascinating area. I really love it. It's a lot of fun for me. I will always probably also do testing as long as I'm trading. For me, you know, it belongs together because you learn so much from the testing for your manual trading and vice versa. Okay, so no matter what your focus is, from experience of the manual trading, the tape reading, you know how markets move. Especially if you're a causality trader, you know how the market mechanics actually unfold. You know what the dumb money does, how the smart money responds, the stop hunting, the position runs, the plausibility, time range principle, etc., etc. So you bring that knowledge to the table when you create a strategy, and the other way around. If you have done a lot of testing, you know what works, what doesn't work, especially when you trade with stops and so on, and that you bring to the table when you do manual trading. Okay, all the testing helps you to become a better manual trader. Okay, I feel strongly about that. Okay, I hope you liked this video. If you did, please leave me a little like or comment. I wish you all the best.